Good afternoon, everyone. My name is Caroline Helmuth, and I am the founder and managing partner of RPY Innovations. We're a consulting company, and it is my privilege to be joined by a group of panelists who I will introduce name, title, and company, but encourage you to go to the ETA's TRANSACT Connect to get more details and background and bio on each of these panelists. I am joined with Todd Ablowitz, who is the CEO and co-founder of Infinicept. Carla Ehrlich is Senior Vice President, ISV Channel, PaySafe. Rod Homuth is partner with me at RPY Innovations. And the final participant is Tom Tucker, leader at Fiserv. What we're going to do is I'm going to ask a couple of questions of each panelist, and then I'm going to allow my fellow panelists to join the conversation. And then we'll go to the next. And then finally, we'll have questions that'll be open to all panelists, and anyone can answer. And unfortunately, we won't have time for questions normally from the audience because this is being pre-recorded. So Todd, let's start with you. In your opinion, what makes an ideal payment facilitator?
Thanks for having me, Carrie. And the ideal payment facilitator is a software company that is focused on often a vertical, not always, sometimes it's a category like invoicing. But the software companies that make excellent payment facilitators are typically touching something that touches the payment function. They typically do more than 50 million in payment volume. If they're slow growing, maybe you want to be a little higher. If they're fast growing, you could go a little bit lower, start a little bit earlier. But they're best for payment facilitators because it's really hard to build software. It's hard. and to build a great product and software and then spend the money and have the distribution to cover acquisition of that software is a really valuable undertaking. So they're well prepared when they're in those categories. But what they then need is they need to learn a little something about payments from someone like your consulting firm. And they probably need to either hire a number of people to build out some technology or use a utility or a set of tools to help them do many of those things.
Even before you launched Infinicept, you were committed to this model. Can you tell the audience why you personally have been so committed as well as Infinicept?
Yeah, it's been a 10-year journey almost. What we saw back in 2011, I've been in merchant acquiring for 23 and a half years, and it's been a mess of process and difficulties. Signing up for a merchant account is like getting a mortgage. 300 questions in triplicate with a voided check. But it went way beyond that. The servicing of the accounts, the disjointedness between a partner that might sell and a partner that might service, it's important to bring those two together. So we've felt for a long, long time that the software companies who build product and distribute it, which is difficult and expensive, we want them to be in the center of the universe for how all these things are done. So we think it's really important that the ecosystem around them, whatever model, whether it's Payment Facilitator or other forms of how to bring software companies into payments, they need to give all the tools, not many of the tools, but all the tools to the software company to properly service that merchant, and thereby bring the beauty of their software product and the abilities of things like onboarding, but also funding and reporting into one cohesive offering that the software company, the payment facilitator, or other model can bring forward.
So the session is on to be or not to be a payment facilitator. And to that end, we have asked Carla at PaySafe to take the counter position. So my first question to you, Carla, is what characteristics of a company make them, in your opinion, ill-suited to be a payment facilitator? When you have conversations with these software folks, when do you believe that it's right to encourage them to consider other models?
Yeah, thanks, Carolyn, and thanks for having me. I don't think companies are necessarily ill-suited per se to become payment facilitators. I just believe that there may be options available to them that are more appealing than taking on the expenses and overhead of becoming a PayFac. PayFacs typically take responsibility for merchant underwriting, onboarding, funding, support, and they also need to be prepared to take on the risks that come as part of merchant and consumer fraud, as well as compliance and regulatory risks from a scheme perspective. And none of this happens for free. So companies that are looking to become a payment facilitator, they really need to be ready to invest. They need to have the right technology, as Todd was speaking about, and they also need to be prepared to hire the right people because it doesn't run itself. So all of these are considerations that they need to be aware of. A few other things that could make them ill-suited to become a PayFac could be the credit policy or risk appetite of your sponsor acquirer. Not all MCCs are allowed under a PayFac model. So depending on the merchant type that you might target and be part of your core merchant mix, you may or may not be well suited to become a payment facilitator. And in addition to that, there are certain rules around the size of merchant that can fall under a payment facilitator model. So sub-merchants typically have to process less than $1 million annually. So if your merchant segment is such that they're at that higher tier where they're processing in larger volumes, you may not be well suited for the payment facilitation model as well.
Super, thank you. So Rod, what would you say is the primary, you talk to candidates all day long, what are you hearing about their motivations to become a payment facilitator? whether or not they're suited, what are their motivations?
Well, the motivation is really becoming universal among all of the integrated payments, integrated solutions providers, SaaS providers, whether or not they choose to go the PayFac path or to follow a path that was closer to what Carla was saying. And that is that, as Todd said, the integrating the payments experience into their overall solution is increasingly important. They want to have a measure of control, not only over their client experience, but their client's end user experience. They have spent their time, their energies growing a company and growing a product that they believe offers a differentiating experience, a superlative experience, and they don't want to change or give away that experience right at the point of purchase to someone whom they have no control over, whom they aren't sharing revenue with, who they aren't, in some cases, don't even have a strong relationship with. So it's about wrapping their influence and their product around the experience from end to end and everything they work with through to their client and their client's end customer.
Would you say that it's about fast onboarding?
It used to be about fast onboarding several years ago, but I don't think that is such a differentiator anymore. Regardless of the payment acceptance model, there's solutions out there today that provide relatively fast onboarding to very fast onboarding, and it becomes table stakes to an extent. I think it's more about focusing on risk management and risk assessment when you're boarding and being able to not only bring clients and merchants on board more quickly, but to do it in a way that is compliant and properly assesses risk and assigns the proper profile.
Isn't it just about owning the merchant contract, or do you think that's not true?
It's very important. Certainly, there are a number of entities who want to own the merchant contract, but that really talks to whether or not they want to take the responsibility and liability. And if they do, they certainly want to see an increase in the valuation of their company for owning those contracts. Oftentimes, it's true, the valuation of the company is enhanced, but it's not a given. As we know in different merchant segments, multiples can be different. There are those who, whose merchant contracts don't generate the type of multiples that would encourage them to take on the risk and liabilities of full payment facilitation. That's something that I think each company has to assess for themselves and according to what their objectives are.
Tom, I'm going to ask you the same question that I asked Todd. Why are you personally and why is your company committed to this model? Because it was a big change.
It was, and it started in 2011 when Visa and MasterCard validated the scheme. And it's an area that Fiserv really wanted to be a part of. And as we look at payment facilitation and the growth within payment facilitation, it's targeted to be trillions of dollars in a very short period of time. More and more, the software companies are looking for that hook. They're looking for the capability to own that client experience. It's a control thing. I think Todd said it right when he said it. They want to be at the center of the universe and provide a single entry point for their software provider to have payments come with. And so the whole model is providing companies with the ability to control that user experience, control what the client has, have an end-to-end process, offer all the different payment types that they might need, integrate reporting back into their AR systems, and really provide the kind of one-stop shop that that PFAC's known for.
We get asked a lot, so I'm going to ask you, Tom. Does the model increase the value of a company to perhaps a PE?
Yeah, I think Rod said it well. It can, and it depends on what stage in their evolution and their life cycle they are as a company. I like to talk about the crawl, walk, run stages of different companies. A company that's got 2 or 3 developers and is just starting out might not be at the point where they want to be a full PayFac. I think Rod said that you could have different functionality. Maybe it's PayFac Lite, maybe it's a different a model, but it can provide a boost in the revenue. And you've got examples of very large payment facilitators around the globe who have high multiples that are very well known, that are household names. And then you've got smaller industry specialization PFAC who that might not be right. That Carla said about the risk and undertaking the risk and understanding the risk, and so that risk might not be viewed as being good for earnings. As we look at the current environment with COVID, there's certain industries that have taken off. There's other industries that have taken the opposite path, and so understanding where you play and understanding the risks in that market and how it will affect your potential earnings or losses is very important.
Do you think, Tom, that a company can expect to see an increase in effective profitability from this model?
I think they can expect it. I think it's really about execution. It's their ability to undertake the tasks that they're required to do. It's the working with the right tech stack, right, working with the right tools. It's developing the monitoring the fraud to limit the downside. So the combination of all the things that are available in the industry, from the consulting on how to do it right, to the tech stack that allows you to actually execute on it, to the acquirer or the partnership that you have with your processor. All of those goes into I think it becoming the endpoint that they want.
Tom, over the last several months, we have been seeing and working with Fiserv the growing need for a strong director of compliance. Tell me what you're hearing. Why is your organization putting such an emphasis on this particular position over the underwriter or operations?
They're all important, but compliance can really be where you get shut down, where you do something wrong, where you don't execute, and where you can run afoul of many different regulations or aspects of the model. So looking at any money laundering and KYC and understanding who you're dealing with, you're really providing that kind of input and that kind of direction to the sponsor bank to protect them, to Fiserv as a whole to protect us, as well as to protect the PFAC. If we can help them along in the compliance aspects of the model, we can help protect them and execute properly.
So I want to ask the team, who in this group, who in your opinion should not become a payment facilitator?
I'll start since I'm the one who gave the pro on being a payment facilitator. I think the most important thing is, if you're not going to take it seriously, regardless of your risk level, regardless of if your goal is to find a fancy technology and get someone to hand you a policy and check a few boxes and try and slide one by the processor, that's probably not a good candidate for a payment facilitator. That's to us the biggest thing. It's critical that you take it seriously. It doesn't have to be an army of people. There are tools, there is support, but take it seriously. If you're going to do it right.
And I'll add to that. I think, to become a PayFac, excuse me, you need a sponsor, right? So you need to be sponsored by an acquiring bank, and to be approved, you need to have strong financials, or you need to have the ability to, put down significant capital so that the acquirer knows that you could handle the inherent risk associated with running your own payment facilitator. As Tom was saying, obviously you also need to adhere to all the regulatory and compliance requirements around AML and KYC and OFAC and match. So a whole slew of considerations there. I think at the end of the day, if you don't know how to manage risk and compliance, and if you aren't in a position to invest in the right tools, people, systems to allow you to do so, there are a lot of other alternatives out there for you that may be a better option.
Recently, we put together a human resources requirements document and an analysis of the revenue that can be made versus the cost of the technology that is needed, as well as the human resources. Often, Carla, brings us back to talking to our client to say, perhaps it is not right for you if your goal is profitability. If they say, no, our goal is that we want to control the merchant relationship at all times, then that is a different kind of thing to be hearing. So I think it's really all about the motivation in becoming a payment facilitator.
Indeed, and I think, I think Rod said this a little earlier, if the goal is to control that end-to-end customer experience, you don't necessarily have to become a payment facilitator to be able to do that. There's great technology out there that would still allow you to own that customer experience end-to-end without necessarily registering or becoming a full-fledged payment facilitator.
So let's talk technology. Perhaps even, well, Todd, when did you start seeing some of the payment platforms being built? Maybe 6 years ago, 5?
We started our first mock-ups for Infinicept in 2013, so 7 years ago.
Yep.
And we got our first V1 product to market in 2015, which was just the underwriting and onboarding portion. Following pretty quickly, and it may have still been 2015, 2016 with the funding and reporting and fee calculation and chargebacks and things like that. But it's been around for a little bit of time, but as many things in payments, there can be a long, slow burn where people raise a lot and spend a lot of money before the market starts to go. And so we usually see that, and I think we've seen that here as well.
Rod, do you think a company can build their own platform to handle everything that an Infinicept would provide?
Well, it is certainly possible. We have seen clients do it and be very successful, but very few of them, to be honest, because as the requirements to be compliant and manage risk and all of the things that go into becoming a PayFac become more stringent, and they are becoming more stringent, it means that the expertise required to build out these platforms has increased. And, we really have to have serious conversations with our clients about taking the focus off their core business. In order to be a successful payment facilitator and to accomplish their goal of the great client experience and control, they cannot be taking their eyes off the ball to enter a realm of developing technology for which they have little background and little understanding. I think the growth and expanse of technologies that are now available to help people become either PayFacs or to take an alternative approach to becoming PayFac are very advantageous. I think the technology is becoming quite a bit more well-rounded and compliant and able to help companies assess their risk and manage it better. In other words, it can be done and it has been done, but it requires an immense amount of focus, which is probably not advantageous to most clients.
Tom, why did Fiserv decide to invest in building a tech stack for this model?
Oh, well, it's both investing in creating a tech stack that people can use, as well as collaborating with others that are doing it. So we see gateways that are connected to us, all kinds of different gateways, and we want to be able to provide connectivity and processing and acquiring on a global basis. From any kind of any of the tech stacks that are out there. We also decided to do it because of the need for us to provide instructional funding capabilities and be able to have tech stacks hit us and provide us the instructions so that we don't have to get into money transmission licenses, have our PFACs get into that. So that was really I think the motivation that got us over that hurdle.
I'm going to stay with you, Tom, for just a minute. The application and approval process is long. Why is that?
It's not always the longest pole in the tent. It depends on readiness. If a client is ready, if the client has the staff, if the client has the policies and procedures, it can go very smoothly and very quickly. But if they're developing out of the gate, then that's the point at which, if you go back to the crawl, walk, run, that's the point at which the policies and procedures from the consulting industry, the tech stack can help provide them the capabilities to get over that hurdle. The ability for the processor to see how are they capable to do the underwriting, to manage the risk. All of that goes into, I think, the application process, and it's not always the longest pole in the tent. So I don't think PFAC is an easy lift, as Todd has indicated, but it's manageable, and there are models out there that help us, where we can help with our shared services capability to provide our back office operations to do the underwriting, where we can provide the interfaces to the tech stacks that are available to provide the automated review and underwriting and OFAC screening. It goes into that model, what's right for them at the time, and will they grow into it? So go from a crawl to a walk to a full-fledged PFAC, can take them on the full journey.
Carla, you don't need to give names if you don't want to, but can you give a success story of an organization that pondered being a payment facilitator and then ended up coming with PaySafe with an ISV model that they feel like was a better decision for them?
Yeah, so PaySafe, is a little bit unique in this space because we do have some of our own proprietary technology, both on the gateway side as well as technology related to some of the tools we're talking about around risk and compliance. But we're also the merchant account facility, either as our own acquirer in some countries in Europe or just through sponsorships in other parts of the world. So at the end of the day, there's no one size fits all model. What's right for one is not necessarily right for another. And I think a lot of people, back to one of your earlier questions, where you said, isn't it all about fast onboarding? And I think a lot of people still think it is. A lot of companies still have relationships with legacy acquirers or ISOs that, in some cases still have a paper-based application that could take 2 weeks to get through the underwriting process. So for them, it's about taking back control of that merchant experience and removing the friction from payments, because their business management software is really intended to be a one-stop shop that removes all the pain of business operations, including payments for their customers. And then when you get into some of the complexities that we talked about and the investment in the technology and in the people to run your program effectively, I think there's a good discussion to be had around, well, are there tools out there that I could leverage and still get the benefit of what's most important to me? In many cases, I believe it's about that customer experience. Certainly, it's about the economics as well. That's always a factor. But can I achieve those most important factors to me without necessarily going through the full-fledged registration process, build out of technology, and build out of human capital to run the program? So to that event, we've had conversations where people came in saying, I need to be a PayFac and I'm nervous about it because I'm not quite ready in the walk, crawl, walk, run analogy. And then they realize that there's other options out there available to them. And in the end, those were the right choices.
We have those conversations too, Carla, and often Rod will say after some conversations with the executives, truly, we don't think that you're ready.
Right.
We're just not hearing the right things. You don't have the right commitment. And there's other models that are really can meet your needs. So let's talk about those. But Todd, can you give us a success story that you have found really they were suited to the model? The model required, their business required the model.
So the first thing I want to react to what you said, Carla. I think it's really important first, there's a big difference between domestic only and multinational applications, and there are companies that make it seem like it's much harder than it is, especially domestic only, and make it seem like it's millions of dollars. And PaySafe's not one of them. PaySafe has a very broad offering, as do many others. But what we see is there are, in low risk verticals, sometimes the vertical is just fundamentally so low risk, even in COVID times, cash and carry. A model that's so low risk that the sound of risk or the fear of risk is what really scares them. So, an example of retail loyalty program that wanted to close the loop on taking the loyalty points and loyalty and frequency and turn that into spend and be able to count the spend. And it's called 5 Stars. They chose to be a payment facilitator, and because they did their diligence and chose acquirers, multiple acquirers actually, that could work with them and invested in a tech stack on the right things and built the right things. They hired one person for their PFAC, and they were able to launch a fundamentally low risk business that's domestic only with the right technology tools. And they did it right every step of the way. And their acquirers will tell you every step of the way they did things correctly, and they got to market. And they estimate that by doing it the way they did it, they saved 6 months minimum and had 500 merchants more than they would have had if they'd taken another path, which was worth millions and millions and millions of dollars of long-term value.
Tom, is the payment facilitation model available globally? Are there some peculiarities in Europe that need to be considered for an organization that wants to be, let's take an easy example, an e-commerce organization that has global vision?
It's definitely available on a global basis, and that was one of the first pillars of our strategic development of our global PFAC program, was that we wanted to make it simple for companies to cross geographic boundaries and provide the same PFAC services globally. A good example of that is one of our PFAC who's presently in the United States, in Europe, in Australia, and will open with us very shortly in Canada. So we're able to provide the same kinds of oversight, the same kinds of requirements, the same kinds of support for them on a global basis. And to your question and your point, there are nuances country by country by country on requirements. So in Europe, you do need to have a regulated license, either an e-money transmitter or a payment institution license. So that is a unique requirement in Europe. In the US, you might equate that to money transmission licenses.
Well, since you brought up NTL, let's just touch on that for a moment. I don't think we have much time left in our session. Is the team starting to see payment facilitators considering getting MTL licenses?
I'll go first. I think the opposite. I think they're looking for the processor to provide the capabilities to have instructional funding so they can avoid that. Some of the very largest and most experienced payment facilitators obviously have them, but as you're emerging and starting, that could set you back by years if you were trying to get your money transmission licenses. So instructional funding is really the answer to help somebody get started, very simply.
I agree with that wholeheartedly, unless there's something really unique around your funding requirements. It can be held in escrow for some period of time and it gets complex, but I completely agree with Tom's position.
Yeah, I would say I'll just echo, there are two things that get people. One is the money transmitter. There are ways that solve this compliantly and safely with good partners like as mentioned. And the second thing is people worry about the limits for payment facilitators. There are correct ways to manage that as well. That's something Carla mentioned earlier. There are correct ways, and if you work with expertise, I highly recommend getting consultants for looking at this. It really does make a difference as you get your operation moving forward.
So one last question for the team. in this crisis, in this moment, is there anything that this model can do to help keep consumers safer, businesses stronger? Is there anything about embedded payments and payment facilitation that can help us in this time?
I'd argue that the ones that are closest to the merchant and therefore closest to the consumer are the software companies that are focused on a vertical many times, and either in a payment facilitator model, which for many we advocate, or in close partnership with your partner, if you're in a hybrid or a different model. That's what's going to, because at the end of the day, it's most important to keep the consumer safe, the merchant safe. And I think that the fact that payments is verticalized in an ever increasing way, that will benefit the consumer and the merchant.
If we can embed the payment so that the consumer has already addressed how they're going to make the payment when they talk to a retailer or a restaurant or a merchant of any kind, I think it's going to be better for this moment. Would anyone else like to add anything to that?
I think Todd said it well. It is about the experience, and if you have the ability to create an experience, you have the ability to enhance an experience, you have the ability to put a full wrapper around your merchant client in terms of how they price, how they sell, and how they can accept payments in a compliant manner. I think that you're in a much stronger position to help, to influence, and to chart a course for both you and your clients. And I think that's applicable in all good payment acceptance models that we have today.
We are out of time. I am very grateful to the panelists and to the audience for enjoying this panel. And I hope that the rest of the TRANSACT Connect is a success for each of you.
Thank you.
Thanks, Caroline.
Thank you.